Let me show you a number that should terrify every paper silver investor on the planet right now. 76 million ounces. That's all the deliverable silver left in COMEX vaults as of March 30th, 2026. Now here's the question nobody on financial YouTube is actually answering. How many paper claims exist on top of that same silver? Hundreds of millions of ounces. I'm going to show you the math live right now, and by the end of this video, you'll understand something most professional investors don't fully grasp yet. Stay with me, because the next 16 minutes might genuinely change how you think about the silver market forever. Before I break down exactly how this fractional system works, let me ask you a straight question. Do you trust the COMEX inventory numbers? Yes or no? Drop it in the comments, because what I'm about to show you might completely change your answer. And before we get into the math, I need to show you something that happened in March, something the mainstream media completely glossed over, that makes this whole situation feel very, very different from past silver stories. What just happened? First, if you're new to this channel, welcome. I'm going to explain everything from scratch, so this makes sense whether you've been watching silver for 10 years or 10 days. Here's where we are right now. Silver just had one of its worst months in modern history. Before we dive in, nothing in this video is personal financial advice. I'm here to break down what's happening, what analysts are saying, and what tools you have available. Always do your own research and speak with a qualified advisor before making any investment decisions. In January 2026, silver hit an all-time high of around $121 per ounce. By late March, it had fallen to the low 70s. That's a drop of roughly 40% from peak. And as of today, March 31st, we're actually seeing a strong bounce, up around 3 to 4% on the day, trading near $73. So why did it crash? Why is it bouncing now? And most importantly, what happens in the next 7 days that could make all of this look like just the opening act? That's what this video is about. Let me give you the 3 forces that drove the crash first, because they're the same forces that are now setting up the next move. Force 1, the Fed surprise. In late January, markets got news that Kevin Warsh, a known hawk, was being positioned as the next Federal Reserve chair. What that means in plain English, markets started pricing in the idea that interest rates would stay higher for longer. Higher rates are bad for silver. Why? Because silver doesn't pay interest, it just sits there. When you can earn 4 to 5% risk-free in treasury bonds, holding silver costs you that opportunity. So money started rotating out. The dollar got stronger. Real yields climbed to around 4.2%. Both of those are headwinds for precious metals. Force 2, the margin call cascade. At the same time, COMEX, the exchange where silver futures trade, started raising margin requirements. That means traders needed to put up more cash to hold their positions. When you force leveraged speculators to post more collateral, the weak hands start selling. And in silver, where hedge funds and managed money had piled in during the 2025 rally, that selling was brutal. It became self-reinforcing. Prices fell, margins got called, more selling, prices fell further. This is what we call a speculative unwind. It's mechanical, it's painful, and it created exactly the kind of deep discount that makes long-term buyers take notice. Force 3, the geopolitical premium fading. Early 2026 gains were partly driven by Middle East tensions, oil price spikes, Strait of Hormuz concerns, safe haven buying. As those fears were priced in and partially calmed, some of that war premium came out of the metal. 3 forces, same direction. Silver got hit hard. But here's what didn't change, and this is where it gets really interesting. The physical market, the actual metal sitting in vaults, being bought by real industrial users and central banks, never stopped tightening. In fact, while paper prices crashed, physical demand accelerated. And that disconnect is exactly what creates the setup I'm about to show you. The main event, ghost contracts explained. Okay, let's get into the real stuff. I want to explain something called a ghost contract. And I want to explain it so clearly that even if you've never traded a futures contract in your life, you'll understand exactly why this matters. COMEX silver inventory has two buckets. Remember these two words, registered silver. This is metal that's been officially warranted and is available for delivery right now. If I buy a futures contract and say, I want the actual silver, this is what I get. As of March 30th, 2026, 76.02 million ounces. Eligible silver. This is metal sitting in the same vaults, but the owner hasn't made it available for delivery. It's there, but it's not yours to claim as a futures buyer. Current eligible stock, roughly 251.6 million ounces. Total COMEX vault silver, about 327.6 million ounces. Now here's where the ghost enters the picture. The front-month futures contract, the one that's about to come due, often carries open interest representing 300 to 500 million ounces of paper silver. In March 2026, we saw open interest peak at 429 million ounces of paper claims, against only 86 million ounces of registered metal at the time. That's a roughly 5-to-1 paper-to-physical ratio on deliverable silver. Most of those contracts roll over. Most traders never intend to take delivery. They're just betting on price direction. But some of them do stand for delivery. In the March 2026 contract cycle, 10,526 contracts stood for delivery, representing 52.6 million ounces of actual silver that people wanted physically removed from those vaults. That's 52.6 million ounces out of 86 million registered. In one contract cycle. Do you see the math problem forming here? These are what I'm calling ghost contracts. Not because anything illegal is happening. This is all completely standard, publicly disclosed financial practice. It's called fractional reserve commodities trading. One physical ounce can back multiple paper claims, as long as most people never actually ask for the metal. The system works perfectly, right up until the moment it doesn't. And in 2025 and into 2026, people have been asking for the metal in record numbers. For 15 consecutive months, COMEX has seen net silver outflows. Let me show you the delivery timeline. 2025 full year, 474 million ounces delivered, more than double 2024. December 2025 alone, 65 million ounces. January 2026, 49.4 million ounces. March 2026, 52.6 million ounces and counting. This isn't speculation. These are CME Group's own published numbers. Now, there's a reason this is accelerating, and it has nothing to do with what's happening in New York or London. It's what's happening in Shanghai. Stick with me. This is the part that most analysts completely miss. The Shanghai drain. Here's the global layer that changes everything. Silver in Shanghai isn't trading at the same price as silver in New York. For most of the past year, Shanghai silver has been trading at a $9 to $12 per ounce premium over COMEX. Earlier in 2026, those spikes hit as high as $26 per ounce. Now, anytime you have the same commodity price significantly higher in one market than another, traders will arbitrage that gap. It's free money, in theory. Here's how the trade works in plain English. Step 1. Buy silver futures on COMEX in New York. Stand for delivery. Take the physical bars. Step 2. Ship those bars to a refinery where they get refined from 0.999 purity up to 0.9999, the stricter standard required by the Shanghai Futures Exchange. Step 3. Sell them in Shanghai at the higher price. Pocket the difference. Simple enough, right? Here's the problem. China's export and VAT rules make this a one-way door. Metal goes in, it doesn't come back out in any meaningful quantity. Refineries doing this conversion are completely backlogged, and the source of the raw 0.999 bars, COMEX and LBMA vaults in the West. So you have this constant structural drain, pulling physical silver from Western vaults eastward into Chinese industrial and investment demand. The LBMA in London still holds around 891 million total ounces, but the free float, the metal that's actually available and unencumbered, is far smaller than that headline number suggests. COMEX registered inventory is the most transparent pressure point, and it's been drained to a 76 million ounce level that we haven't seen in years. Now combine that with record delivery notices in the futures market, and now add what's coming this week. April 1st Notice Day opens this week. I want to show you exactly what to watch, day by day, and what specific numbers will tell us whether this is a routine settlement or the beginning of something the market genuinely isn't prepared for. April 2026, the setup. Let's talk about April. The April 2026 COMEX silver futures contract is entering its first notice day window right now, the period when holders of long futures positions must declare whether they intend to take physical delivery. As of the latest update, 1,726 contracts representing 8.6 million ounces were still open as pre-first notice day standing began. That's early. First notice day deliveries typically build over several sessions. If standing delivery notices spike the way they did in the March cycle, registered inventory, already at 76 million ounces, could drop into critically low territory within days. And that matters because of something called backwardation. What is backwardation and why should you care? In a normal futures market, silver for future delivery costs slightly more than silver today. You're paying for storage, insurance, financing. That's called contango. It's normal. Backwardation is when the near-term price is actually higher than the future price. That only happens when people are desperate for the metal right now, when the physical shortage is real and immediate. We've seen brief flashes of backwardation in silver in recent months. If delivery stress in April is severe enough, we could see sustained backwardation, a market signal that the physical shortage is no longer theoretical. That's the market telling you. The metal is scarce. Get it now or pay a premium. The April 3rd wild card. Layered on top of all of this is Friday's U.S. jobs report. April 3rd, 8:30 a.m. Eastern. This is the highest impact U.S. economic data release of the week. Strong jobs report, markets price in fewer rate cuts, dollar strengthens, pressure on silver. Weak jobs report, cooling labor market, more rate cuts expected, dollar weakens, silver rallies. Right now, silver is hypersensitive to both of these catalysts simultaneously, the COMEX delivery story and the macro data story, which is why a 5 to 10% move in either direction this week is not only possible, it should be expected. I'm not predicting direction. Nobody can do that, honestly. What I'm telling you is that the volatility window is wide open, and the structural conditions underneath the price are unlike anything we've seen in a long time. The bigger picture. Here's what I want to be clear about, because I think nuance matters more than hype. I'm not here to tell you the system collapses tomorrow. I'm not here to tell you to buy silver because the apocalypse is coming. What I am here to tell you is this. 2026 is on track to be the 6th consecutive year of a global silver supply deficit. That means every year for 6 years running, the world has consumed more silver than it has produced. Solar panels, electric vehicles, AI data centers, medical devices, advanced electronics. These industries don't stop needing silver because the futures price is volatile. The industrial demand is structural and growing. And the supply side? Silver mines aren't magically producing more metal. The primary supply deficit forecast for 2026 is around 182 million ounces. Again, the long-term story for silver is not broken by a brutal March correction. In fact, corrections like this are precisely what the long-term bull case is built on. They shake out the paper speculators and transfer metal from weak hands to strong hands. Central banks are still buying. Industrial users are still contracting. The physics of the supply-demand equation doesn't change because hedge funds got margin called. But, and this is important, that long-term thesis plays out over months and years. The next 7 days are tactical. They're about positioning and volatility, not about the ultimate destination. One more thing before I wrap this up. I want to give you the 3 specific numbers to watch this week that will tell you everything you need to know about whether April's delivery cycle is routine or historic. Give me 90 seconds. The 3 numbers to watch. 3 numbers. Write these down. Number 1, 76 million ounces. That's current COMEX registered inventory. Every day after market close, CME publishes an updated number. If this drops below 65 million ounces this week, the delivery stress is real and accelerating. Number 2, the Shanghai premium. If the SHFE COMEX spread stays above $9, the arbitrage drain continues. If it spikes past $20 again, the east-west flow is intensified. Watch this every morning. Number 3, Friday's non-farm payrolls. Consensus expectation is somewhere around 150,000 to 180,000 jobs. A miss below 120,000 would be the macro fuel silver needs. A beat above 220,000 would pour cold water on any rate cut narrative and pressure the metal short term. Watch those 3 numbers. They'll tell you more than any pundit on TV. Bottom line, and I mean this seriously, the only silver contract that can never become a ghost contract is the physical metal in your possession. Whether you're in futures, ETFs, unallocated accounts, or mining stocks, understand exactly what you actually own and what you don't. This isn't fear-mongering. It's reading the publicly available CME and CFTC data and following the logic where it leads. If this video helped you understand something you didn't fully understand before, drop a ghost in the comments. If you want me to do a live April delivery tracking video this week, hit like so the algorithm knows this content matters, because I'll only make it if enough people want it. And if you're new here, subscribe and hit the bell, because in a week like this, updates can come fast. I don't want you to miss them. I'll see you in the next one. Stay stacked.